Welcome to our video on maximizing retirement savings by understanding the shared limit rule, the double-dip strategy across different plan types, and how to choose between pre-tax and Roth contributions. We'll cover how contribution caps work, how to avoid common pitfalls, and how to structure your contributions for tax efficiency. In this agenda, we will first define the shared limit rule. Next, we will explain the double-dip strategy across different plan types. Then we will present a framework for choosing between pre-tax and Roth. After that, we will cover catch-up contributions and plan coordination. Finally, we will provide an action plan, highlight common mistakes, and include quick quizzes to reinforce learning. This topic matters because misunderstanding how shared limits work can cause people to underutilize or misallocate their retirement contributions. Conversely, knowing how different plan types interact can allow someone to contribute more overall, especially when both a 457B and a 401k or 403B are available. This video is for educational purposes only and does not constitute tax, legal, or investment advice. Always consult current IRS publications and a qualified professional. Contribution limits, catch-up rules, and plan features change. State taxes and your personal situation can materially affect the best choice for you. Within a single plan type, such as a 457B, the combined total of Roth and traditional contributions cannot exceed the annual IRS elective deferral limit. The same principle applies within 401k and 403b plans. You may not treat Roth and traditional as separate buckets with separate limits in the same plan type. Always reference the latest IRS guidance, because limits change. Also note that employer matching contributions and any after-tax features, if available, are governed by additional rules that are described in your plan documents. This pie chart is a conceptual visualization. It illustrates that within one plan type, the mix between traditional and Roth is flexible, but the aggregate must stay within the annual IRS cap. You could choose 100% traditional, 100% Roth, or any combination. The important point is that you do not have separate caps inside the same plan type. Quiz question. True or false? In a single 457B plan, you have separate annual limits for traditional and Roth contributions. Option A is true. Option B is false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, false. Within the same plan type, Roth and traditional contributions share a single combined annual limit. The double-dip strategy refers to contributing the full elective deferral limit to a 457B and, separately, the full elective deferral limit to a 401k or a 403B when both are offered. This is allowed because 457B plans have a separate statutory cap from the 402G limit that covers 401k and 403B plans. However, 401k and 403b deferrals share the same 402g limit with each other. Therefore, you cannot double your elective deferrals by using those two alone. If you work for multiple employers, you must coordinate your 401k and 403b elective deferrals across all employers because they share one 402g cap, while your 457b elective deferrals are under a separate 457b cap. On the left side, we have 401k and 403b plans, which share the same 402g elective deferral cap. Within each plan, Roth and traditional contributions share a single cap. Many of these plans include employer matching, depending on plan rules. On the right side is the 457b plan, which has a separate elective deferral cap. Within a 457b, Roth and traditional also share one cap. The key distinction is that a 457B can be combined with a 401k or 403B to effectively double elective deferrals because the 457B cap is separate from the 402G cap. This section emphasizes not defaulting to Roth. If your current marginal tax bracket is 22% or higher, many experts tend to prefer pre-tax contributions because the immediate tax deduction often provides a stronger compounding base, and the expectation is that your effective tax rate in retirement may be lower. Nevertheless, this decision is personal and requires analysis of your income trajectory, expected retirement income sources, and tax regime. This timeline depicts typical career stages and how tax brackets often evolve. In early career, taxpayers may be in lower brackets, which can make Roth contributions appealing because paying tax now may be relatively inexpensive. As income increases into mid-career and peak earnings, the tax bracket tends to rise, making pre-tax contributions more compelling due to larger immediate tax savings and an increased compounding base. In early retirement, income may decrease, often resulting in a moderate bracket where withdrawals from pre-tax accounts may be taxed at lower rates than during peak earnings years. Later retirement may feature a similar or slightly lower bracket, depending on required minimum distributions and other income sources. The key takeaway is to align contribution type with your current and expected future tax rates. Use this practical framework. If your current marginal tax bracket is relatively high, often 22% or higher, lean toward pre-tax to capture meaningful tax deductions and grow a larger compounding base. If your current income is temporarily low or you are early in your career, consider Roth because paying tax now may be relatively inexpensive. If you expect higher tax rates in retirement, tilt Roth. If you expect lower tax rates in retirement, tilt pre-tax. When uncertain, blend contributions and revisit the decision each year as your circumstances and tax law evolve. This table summarizes catch-up contributions and special rules. For 401k and 403b plans, an age 50 catch-up is generally available. These plans do not offer the same special catch-up mechanism that 457b plans do. For 457b plans, in addition to age 50 catch-up, there is a separate special catch-up that may be available in the final years before normal retirement age if you previously underutilized the plan. Usually you cannot use both the age 50 catch-up and the special 457b catch-up in the same year. Also, remember that 401k and 403b deferrals share one 402g cap across employers, so you must coordinate totals. Always verify specifics in your plan documents and with your plan administrator. Follow these steps. First, verify the plan types available to you. Second, look up the current IRS limits and update your payroll elections accordingly. Third, if you have both a 457b and a 401k or 403b, plan to contribute up to each separate cap. Fourth, select pre-tax or Roth based on your current marginal tax bracket and your expected future tax rate. Fifth, reassess mid-year and annually as circumstances change, such as raises, bonuses, or job changes. Sixth, coordinate catch-up contributions and be mindful not to double count across employers where 401k and 403b share a single 402g limit. Seventh, read your plan documents to understand employer match provisions, any after-tax features, and whether Roth is available. Finally, document your approach to maintain consistency and track progress. Quiz question. Which combination allows you to contribute up to 2 separate elective deferral limits in the same year? Option A is 401k plus 403b. Option B is 2 403b plans at 2 employers. Option C is a 457b plus a 401k or 457b plus a 403b. Option D is Roth plus traditional within one 401k. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. A 457b has a separate elective deferral limit from the 402g limit that applies to 401k and 403b plans. Therefore, if you have both a 457b and a 401k or 403b, you can contribute up to each plan's limit in the same year. Common mistakes include believing that Roth and traditional contributions have separate caps within one plan type, attempting to double elective deferrals across 401k and 403b plans despite the shared 402g limit, failing to coordinate deferrals across multiple employers, defaulting to Roth contributions while in a high tax bracket without analyzing the trade-offs, and overlooking catch-up rules or timing windows defined in plan documents. Here is a quick recap. Within one plan type, Roth and traditional share a single combined cap across different plan types, such as a 457b and a 401k or 403b. You may have separate caps that allow higher total contributions. For tax efficiency, Pre-tax contributions often make sense in the 22% and higher brackets, but reassess the decision each year. Finally, use catch-up provisions thoughtfully and coordinate across plan types and employers. In summary, confirm which plans you have and the applicable contribution caps before setting elections. If you have both a 457B and a 401k or 403B, consider maximizing each to take advantage of the separate caps. Choose between pre-tax and Roth contributions with a tax-aware mindset rather than relying on rules of thumb. Reassess annually since limits, income, and goals change. Finally, consult plan documents and qualified professionals for personalized guidance. Thank you for watching. If this video helped you, please like the video, share it with someone who might benefit, and subscribe to the channel for more content. In the comments, let us know whether you favor Roth, pre-tax, or a blended strategy and why.